On Wall Street, China's seldom far from investors' minds. What happens in the world's second largest economy has the potential to have a huge impact here in the biggest one. By downgrading China's credit rating, Moody's is saying China's debt is likely to grow substantially while the economy slows down. In other words, when China sneezes,
the rest of the world gets sick, but this downgrade by Moody's has nothing to do with a cold. It's not even a sniffle.
The downgrade is not an enormous surprise to some China watchers.
The talks of Chinese debt and concerns about the size of Chinese debt has been going on for the last few years. They seem to be very reliant on these high levels of growth, which is slowing.
Not surprisingly, all this hasn't gone down too well in China. Beijing rejects Moody's opinion that financial growth may fade, with the finance ministry accusing Moody's of exaggerating economic difficulties and underestimating reforms. And credit ratings have been discredited in the past, most notably when all of them failed to anticipate the 2008 global financial collapse. China's debt is mostly internal, government and state-owned. Little of it extends outside China. That may be why Wall Street and global markets hardly seem rattled, even though some worry China will rein in imports from key world markets. On global stock markets, shares dipped a little on Moody's announcement. Chinese currency, the yuan, slid a little against the US and Aussie dollars. The Aussie dollar is seen as a surrogate for the yuan because Australia is China's major trading partner in the region. In Sydney, the all-ordinary share index was down in certain sections. Shanghai dipped too, but later recovered. Heavy metal and mining stocks among those affected. Dan Alpert of Westwood Capital says the big difference between China and Western economies is that China is managed for employment, not a balance sheet.
None of the things that Moody's talking about, right, has any merit outside the strict interpretation of a purely capitalist economy. And China is not a purely capitalist economy. It is, as we all know, capitalist with Chinese characteristics.
Meantime, China's leaders have identified the containment of financial risks and asset bubbles as a top priority for this year, even at the expense of some reform programs. On Wall Street, they're looking the other way right now, consumed with Trump and record-high stock markets. Many remember all too well what happened when several rating agencies downgraded the US economy in 2011. Absolutely nothing. John Terrett, CGTN, New York.